something really popular right now in the real estate space are these three terms I'll kind of throw out there and see if you can help define them in simple ways. That was a great definition, by the way, of depreciation. So the three kind of terms I think that all kind of fit together are accelerated depreciation, bonus depreciation, you hear a lot about decently right now, and then this thing called a cost seg report or a cost segregation. Could you explain just how those work together and how they help an investor who has rental properties pay either less or zero in tax?
Yeah, for sure. So like I said, the standard depreciation for residential property is 27 and a half years. Okay. But then people get smart and we say, okay, well then what exactly is the definition of a building? And can I then take this building and break out things that I don't deem to be building? And that's what a cost segregation is. The cost segregation says, okay, Sam bought this building for $500,000, but maybe Sam doesn't really know what makes up the building unless Sam happens to be an engineer, right? So what we can do is we can hire cost segregation firms, most of them are the engineers, and they'll look at this specific building and say, okay, from this building, I'm going to break it out into components, which is cost segregation, separating out the cost of that $500,000 building. And so what they're doing, they're saying, okay, in this building, maybe there's $30,000 of specialty plumbing. Maybe there's another $100,000 worth of appliances and fixtures and little components and cabinetry. And once they do that, then us, or your CPA, will take a look at the components and say, well, guess what? If it is specialty plumbing, maybe I don't have to depreciate over 27 and a half years. Maybe I can do it over 15 years. Maybe for some of the fixtures, I can do it over 5 or 7 years. And when we're doing it over these shorter amount of times, you can see $100,000, if I have to take it over 27 years, it's going to be a much lower number than if I have $100,000 where I can write off all of it over a 5-year period. So that's where that cost segregation concept comes from. Historically speaking, for rental real estate, that's done wonders for real estate investors, just being able to accelerate some of the depreciation. But what's amazing is in the last several years, the laws have changed temporarily to make that even better. And that's where you hear the term bonus depreciation. So bonus basically says any of these things that we're now calling 5, 7, or 15-year assets, I'm not even going to wait the 5 years. I'm just going to take immediately as much as I can in year number one. And so, for example, if, this year we're saying it's 60% bonus, that means, if it was $100,000, I'm not going to write it off over 5 years. I'm going to take $60,000 of that immediately this year. And then the rest, the remaining 40, I'll take it over the next couple years. And so this is where you're seeing hearing a lot of people say, wow, I bought a rental, I did cost segregation, bonus depreciation, accelerated depreciation, and then I got a $200,000 loss, right? It's not losing money. It's very profitable by itself, but I've now supercharged the set of tax law to create a paper loss for tax purposes.
Yeah, that's beautiful. I've really been enjoying some bonus depreciation on some of my property. And I think what's really interesting about this concept is now you get investors, and I want to ask you about this because now you get investors that are looking to buy real estate who don't know anything about real estate only for depreciation. I had someone come to me recently that was like, I need to try to write off, I forget the actual number. I think he was going to owe maybe $400,000 in taxes. And he was like, I'm looking for a building just to get rid of the $400,000. I was like, well, great. Like, what's the cash on cash return you need? And he was like, return? I break even. Like, if the building breaks even, I'm good. I don't want to pay $400,000 in taxes this year. So he was looking for some big multifamily building, right? And I want your professional opinion on that exact scenario. Like, is it advisable, in your opinion, to buy a building so that I can pay zero in taxes, even if that building just barely breaks even once all things are included? I'm curious your opinion on that.
Yeah, I feel like that's never a good idea. I hate to use the word never, but that's rarely ever a good idea, right? Because when it comes to taxes, our tax rate is never 100%. Right. So even like in your friend example, the audience question we had, $600,000 income in California, I'm mostly paying maybe like 50% in taxes. So I never want to lose $100 just to save $50 in taxes. Right. So as an investor, first and foremost, I'm still always looking for properties that cash flow and appreciate, right? If I can get both, great. If I can only get one of the two, then I have to think about it. What's more important to me at this stage in my career or in my financial journey? But yeah, it never makes sense to just buy a property that's underperforming just for the tax benefits. Because again, I never want to spend $100 I didn't need to just to save $50 in taxes. Now, the tax side does have an impact though on what you invest in and when you invest in. Just like we were talking about with that audience question, right? If they're both working full time, if their goal is to not pay tax on W-2 income, well, maybe we want to get a property close enough to them where one of them could be a real estate professional. Or if they're going to just continue working full time, then maybe we want the property to at least temporarily be a short-term rental, or in the first year or for the first 2 years, right? So it does impact what kind of real estate and where the real estate is and when you buy it during the year. But we never want to buy a bad property or a mediocre property just to save on taxes.
I love your perspective on that. So still vet it, still make sure what I'm hearing from you is really valuable. It's like, hey, make sure you're either getting cash flow from that thing or you're pretty dang sure it's going to appreciate because of where it is or what type of real estate asset it is, or maybe there's a long-term lease on it with rent increases or something like that. Like make sure that thing is going to appreciate. I like that.